Business owners and Division 7A loans. Let's have a bit of a dive into some situations I've seen with Division 7A loan operations being set up by an accountant with some clients that I have seen and why they can be very dangerous. And I'll give you one example that comes to mind, and this is for a particular client that I was working with, and I still do work with them, but they've been on a Division 7A loan arrangement through their business for many, many years. That was set up through their accountant. And what a Division 7A loan essentially is, and why most people commonly would have a Div 7A loan arrangement set up, is through periods of the time where the business may be struggling, you're accustomed to a certain lifestyle. Rather than paying out your income through the business as wages or dividends, because maybe there's no profit whatsoever, or there's no company tax or tax paid up in the franking account, you instead start pulling out the money from the business, and it gets called a Div 7A loan arrangement. So no tax is actually withheld from the actual withdrawal of that money. So essentially pulling that out, and that becomes a loan repayable back to the business over a period of time, and as a nominated or a nominal rate of interest that you have to pay on that the ATO sets as well. And where these can be very dangerous that I've seen is people become accustomed to the lifestyle of what they're pulling out from the business, which is not being taxed. So as an example, you're pulling out for $500,000 from your business via a Div 7A loan arrangement year on year after a while. If you're taking $500,000 out of your business, let's just say between yourself and your partner, $250 each, let's just say on that scenario, you might be netting $180,000 each, let's just say. So you're left in your pocket $360,000 combined. Whereas with a Division 7A loan arrangement, you pull out that $500,000, you've got no tax to pay or declare in that situation. In simple terms, let's just say, and you get accustomed to living off that $500,000 of income or money. And then the problem there is at some point in time, that money has to go back into the business and it needs to be declared year on year. And I've seen this happen many times now where people dig themselves into a hole and they ultimately don't know how to get out of it. And they end up in a situation with these big Div 7A loan arrangements sitting on their balance sheet, and they're ultimately accustomed to a higher level of lifestyle than they can afford based upon the size of the business or how their business is tracking. So you need to be very wary of getting on a Div 7A loan arrangement. If you're a business owner and you want to have a chat about this, feel free to reach out.